bank reconciliation statement. So let's take the balance as per cash book. The cash book balance is 105. Okay, we should arrive by reconciling. Okay, it should match with balance as per bank statement. Balance as per bank statement is 110,000. So when you start with the cash book balance, we should arrive at the bank statement balance. So in between, there will be pluses and minuses for the differences. The adjustment we have to make for the differences. Either there will be an addition or deletion. Today I thought of starting a new topic. It's going to be a very interesting topic. I hope you guys will enjoy. Okay, so that is the bank reconciliation statements. Now before I move on to this explanation, detailed explanation, okay, I will start with a small story. Okay, story between two accountants. Okay, so let's say there's a company. Let's say a company name is SBS company. Okay, so SBS company, there is an accountant. Okay, we'll assume there's an accountant working in this company, and also we'll assume the bank as commercial bank. Okay, so commercial bank, there is another accountant. Okay, so what is the story I'm going to tell now? Story between two accountants. One accountant is in SBS company, the other accountant is in commercial bank. Okay, now let's start with this. Okay, two accountants. Okay, now let's say the company owners, okay, the owners of the company, they have decided to invest cash. Okay, so let's say they invested $100,000. What the accountant will do? It has to be debited to cash account. Okay, cash debit, capital account credit. So credit, this should be the double entry. Okay, so this is based on the double entry concept. No, this is based on the double entry concept. Double entry concept says when you debit one account, you have to credit the other account. So basically, if you take the accounting equation, assets equals equity plus liability, right? So your assets total should match with equity plus liability. Now, since he has invested cash, okay, so the cash is an asset, right? So cash will increase by 100,000, and on the other hand, the equity will increase by 100,000, right? This is the capital, right? So your balance sheet equation is tallied. It's balancing, right? So this is based on the double entry accounting concept. So his accountant will debit the bank account and credit the capital account. So you need to post this to the general ledger. Okay, so what is the general ledger? You have a cash book. So here the cash book means, please remember, okay, two column the cash book, two columns. Okay, so which is the cash column and the bank column, right? Just assume like that. So if you take this, so these are not straight. Okay, now the owners have invested 100,000, so he has to debit the cash book, right? So this is capital account will be credited, the cash book will be debited. Okay, is that clear? Okay, now the accountant was asked to open a bank account with the bank, right? Now if the owner, if the company wants to open a bank account, what they have to do, what the accountant will do? Accountant will simply, what he will do? He will credit the cash book, right? When you deposit cash, what he will do? Simply, he will credit the cash book, okay? And he will debit the bank column, right? Contra entry, no? This is bank, this is cash. So this is what he will do. Who? The accountant of SBS company, this company, okay? So why he is doing that? Because simply your cash is reducing and another asset is increasing. That is a bank account. You understand? So bank account balance is increasing. Okay. Now, when you deposit this 100,000 to the bank, okay, so before you deposit, you have to open up an account with the bank. Am I right or wrong? Yes. The accountant, this accountant, okay, has to go to the bank. He's going to the bank and he has to open up an account, right? So in order to open an account, what do you have to do? The accountant has to fill up a form, right? So you will be given an application form. So you just fill up that and get the signatures from the owners and you just deposit. That's a normal process, right? Okay. Now he goes to the bank and he has to open up a bank account and he is going to deposit. Okay. Now the commercial bank accountant, okay, from the point of view, now you just forget about the company accountant. Think about the commercial bank accountant from point of view, okay? So from commercial bank accountant's point of view, he is receiving cash, right? Okay, the bank is receiving cash, right? 100,000. When he receives cash, what the accountant would do? The commercial bank is a separate entity, right? It's a separate entity. The accountant has to follow the normal double entry concept. What is the normal double entry concept? See, assets equals equity plus liability, right? He has to follow the same rule. What is the rule? He is receiving cash. So what he has to do is cash is increasing. Commercial bank cash is increasing by 100,000 and liability increases. Why? This is a very important concept. The liability of the bank increases. Why? From the point of view of, this is very important, okay? Very, very important, this concept. From the point of view of the bank, bank receives cash from SBS company, right? So SBS company is a liability for the commercial bank. Is that clear? Okay, so therefore the commercial bank accountant has to what? Increase the liability, increase in liability, and the commercial bank cash account should be debited. Okay, so what is the double entry? He has to pass a double entry. The cash book will be debited by 100,000 and he will credit the liability of SBS company. Okay, so the commercial bank accountant, what he will do, he will debit the commercial bank account cash book, right? Commercial bank account cash book. This is their cash book. They will debit and they will credit which account? They will open SBS company. Account will be credited by 100,000. So this is SBS and this is the commercial bank account, cash book account. Okay, right? Is that clear? Okay, so after opening a bank account, now basically at the end of every month, this is very important. At the end of every month, the SBS company accountant has to close his books of accounts, right? In the meantime, if you take the commercial bank accountant will also close his books of accounts, right? Okay, so what he will do, the commercial bank will send a statement called bank statement to SBS company. Okay, so usually banks will send bank statement to almost all the customers who has opened a bank account with the bank. They are supposed to send a bank statement. Then only you will come to know what transactions you have done during a particular month. You understand? Every month you will get a bank statement. Okay, so bank statement will look like this. So if you take a bank statement, okay, bank statement will look like this. So let's say the company deposited the money 2020. Okay, so the company deposited, right? So this is the SBS company account. So this is what they are going to show you in this columnar format. Okay, so since this amount was credited, this is credit, right? This is on the credit side, no? This is the debit side. So when the company, the commercial bank receives the amount, they will say deposits. Okay, on the credit side, 100,000, the balance is 100,000. Okay, so you will receive this statement. When the company accountant receives this bank statement, what he has to do? He has to compare with his cash book, right? Okay, so the credit side of the bank statement, so this is on the credit side, right? Why credit side? Now I explain you. Because from the bank point of view, SBS company is a liability. So that's why they are showing on the credit side. Okay. So when the bank statement is received by the company accountant, what he will do, he will compare with his bank account, with the cash book. Okay. So he has to compare with debit side or credit side. When you receive the bank statement credit side should be compared with the cash book debit side. Why? Because from the point of view of SBS company, the cash deposited is an asset to them. That's why it's on the debit side. Okay, we debited the bank account and we credited the capital account. That is a separate set of books in the company. From the bank point of view, the bank debited their cash book and they credited our account, SBS account, because it's a liability. Okay, so therefore, when you compare the debit side in the cash book, you need to compare with credit side. So reconciliation means you are reconciling your cash book balance with the bank statement, which means you are comparing whether it is matching. Okay, so therefore, bank reconciliation statement means you compare bank statement balance with the cash book balance and you are comparing whether it's matching. Okay, so usually at the end of the month when you receive the bank statement, you have to compare with the cash book balance. Usually it will not match. There are so many reasons. Okay, so this is what I want to explain you. The first concept you should know, when you prepare a bank reconciliation statement, what is the first step? You need to compare your credit side of the bank statement with the debit side of the cash book. So debit side of the cash book with the credit side of the bank statement. If it is a credit side of the cash book, then the debit side of the bank statement. This is very, very important. Okay, this is the first concept that you should know before preparing a bank reconciliation statement. So this is therefore what we call it bank reconciliation statement means, okay, we compare the bank statement with the cash book balance to identify whether the balances are matching. This is known as bank reconciliation statement. So when you prepare a bank reconciliation statement, the debit side of the cash book should be compared with the credit side of the bank statement, and credit side of the cash book should be compared with the debit side of the bank statement. Is that clear? Okay. Now the company's book, okay, the company's accountant, he would have debited the bank column and he would have credited the, what do you call, the capital account, okay, or the capital account, let's say capital, okay. Now this amount is deposited in the bank, right? So when the money is deposited in the bank, so where the bank will record? Which side the bank will record? Credit side, right? So the bank will record it on the credit side. So therefore the balance will be 100,000, right? So because I told you from the bank point of view, when they receive cash from the company, okay, so they will open a bank, what do you call, an account in favor of the company. Okay, so let's say the company, let's assume again as SBS. So this is the bank statement for SBS from bank point of view. So what the bank does is they credit the SBS account and they debit the bank cash book. Okay, the first entry is done. I hope it is clear, because it's a liability, whereas here it's an asset. Okay, on 5th January 2020, pay to Peter $20,000 by a check. Now what has happened? So once you open a bank account, you can do transactions through checks. Okay, so bank will issue a checkbook. Then you can write a check and you can pay to your suppliers. Okay, here the Peter means your supplier. You have bought goods previously and now you are settling to your what do you call, supplier. Is that clear? So when you pay, what is the entry the company accountant will make? He will credit, no? He will credit the bank account. It's a payment, right? So 5th January 2020, Peter, okay, 20,000. Okay, and Peter's account will be debited. It's a creditor, right? So you have a liability you are paying to your creditor. So you have to debit the Peter's account. So I'm not going to show those entries, right? So here the topic is bank reconciliation statement. So therefore, the transactions relating to bank reconciliations, I will explain you. Okay, now from the bank point of view, the bank will issue, the supplier will go to the bank and he will present the check to the bank. The bank will pay to they will make the payment to the supplier, Peter. So when they pay on 5th January, okay, this is the check payment. What they will do? They have to debit or credit? Yeah, they have to. The bank will debit our account. Why? Yeah, liability decreases. Okay, your liability is reducing. From the bank point of view, bank's liability towards SBS is reducing. Okay, see, by how much? By 80,000. Sorry, by 20,000. Therefore, your balance reduced to 80,000. Is that clear? Okay, now here also you can check 100,000 debit, 20,000 credit. Your balance should be debit 80,000, whereas your balance in the bank statement should be on the credit side, credit 80,000. I hope it's very clear. Okay, if you have any doubt, please ask me anything. Okay, please clarify then and there. Okay, now 15th January, what's happening here? Received from someone, a customer, 30,000, and it was deposited in the bank. Okay, now you received an amount of 30,000 from your customer. Customer is your debtor, right? So debtor is paying. So when you receive cash, you debit your bank account and you credit your customers. So this is SBS point of view. Okay, so you deposit this 30,000 in the bank and you credit someone. Someone is your customer. From bank point of view, this is on 15th January, right? When you deposit this check, what happens? It will be credited, right? We are depositing. So therefore, your balance is 110,000. Is that clear? Okay, up to now it's very clear, right? Okay. Now, on 30th January 2020, paid to Silva 15,000. However, it was not presented to the bank. Now, what happened? SBS company issued a check worth 15,000 to their creditor Silva. Okay. So when they issue, the accountant, what he will do? He has to credit, no? You have to credit your bank account, right? 15,000. So when you credit here, the supplier will go to the bank and he has to encash it, right? He has to present the check and he has to encash it. But what has happened? It was not presented to the bank. This is very important. Please remember, what has happened? You have given the check to the supplier. Supplier is supposed to go to the bank, but he did not go to the bank and he did not present the check. Okay, so will the bank debit our account till they receive the check from the supplier? No, no way. They can't do that. Okay, the supplier has to go and present the check to the counter. Then the cashier will take the check and they will debit our account. Until such time, it will not be done. They don't know about the check. You understand? So therefore, there is no transaction happen here on 30th from bank's point of view. Okay, they are not aware of this check. Whereas the accountant of your company, SBS company, he knows. He has issued a check. So he has to account it. He has to account it. He accounted. Okay. Next, 30th January 2020, received from Stephen 10,000, deposited in the bank, but not yet realized in the bank. Underline these two. So not presented and not realized. So Stephen paid how much? 10,000. So from company's point of view, the company has received how much? 10,000 from Stephen, right? Stephen. You received 10,000 from Stephen. But you deposited. The company accountant has gone to the bank and he has deposited the check. But the bank, the amount was not realized. What does it mean? This is very important. Please understand this concept. So you are going to the bank, the SBS accountant, he goes to the bank and he deposits to the bank. When he is going, on 30th January, right? 30th June means 31st is the closing date, end of the month, right? So when you deposit to your bank account, this customer would have issued the check from his bank, right? So therefore, our bank should get a clearance from Stephen's bank. Until the accountant of our bank gets a clearance, he will not credit to our bank account. Is that clear? Okay. So even though you deposited, the accountant knows he deposited. So he will debit our bank account, right? But he has to go and deposit. He deposited, but the bank will have to get a clearance from Stephen's bank. But until 31st December, they did not get a clearance. So can the bank credit our account? They can't do that. They will not do that, because if they credit, supposing the Stevens bank doesn't have money, how our bank will get the money? How they will get the money? They can't do that, right? They have to get a clearance. Usually it will take 1 or 2 days to get a clearance. By that time, our bank will have to close their books, right? By 31st January. You understand? By 31st January, our bank will have to close the books of accounts. By that time, they have not got the clearance from the bank of Stephen. So therefore, they will not credit. Okay, now the story is finished. Okay, now we are moving towards the what do you call, the end of the month. We have to close the books, right? Now what he will do? The bank, our accountant, he has to balance this account. So what is the debit side? So he deposited initially 100. Someone received 30,000. Stephen also paid 10,000. So 140,000. Here also 140,000. So the balance will be 105. 31st January 2020. Balance carried forward 105. However, as you can see, the bank statement balance is 110. Now at the end of the month, I told you by 31st January, the balance is 110,000. The bank will send you the bank statement. Okay, the bank will send you the bank statement. So according to the bank statement balance shows as of 30th January 110,000, whereas our cash book balance shows 105. Okay, so I told you, when you compare, usually the bank statement balance will not balance with our cash book balance because of differences. Okay, now when you receive a bank statement, what you should do? I told you. What is the first thing you have to do to reconcile? You need to compare debit side of the cash book with the, okay, what is that? Debit side of the cash book with the credit side of the bank statement. Then credit side of the cash book with the debit side of the bank statement. Okay, now we'll compare. This is the reconciliation that we are doing to identify the differences. Okay, so what is that? We deposited 100,000. Has it been deposited? Yes. Put a tick. Okay. Someone deposited 30,000. Okay. The cash book is debited. Has it been credited to the bank account? Yes or no? Yes. 30,000 has been credited, right? Okay. Then we deposited 10,000. Has it been credited to the bank account? No. So therefore, there is a difference, right? This 10,000 is the difference. Okay. Now debit side we compared with the credit side. Now you compare credit side of the cash book with the debit side of the bank statement, right? Okay. The first one, we issued a check to Peter, 15,000. Has it been presented? Yeah, presented means debited. We issued a check for 15,000. Has it been presented? No. So the second difference. What are the differences? Why these two are not balancing? First one is because of this 10,000. Okay, Stephen's check, 10,000. What is that? This is a deposit not realized, right? Not realized in the bank. Second one, what is the second difference? We issued a check to Silva, 15,000. Okay, so this is check issued, but not presented in the bank. Is that clear? Okay. Okay, what is the balance as per cash book? 105, right? Balance as per bank statement, 110. Okay. Now, When you prepare the bank reconciliation statement, this is the bank reconciliation statement. So let's take the balance as per cash book. The cash book balance is 105. Okay, we should arrive by reconciling. Okay, it should match with balance as per bank statement. Balance as per bank statement is 110,000. So when you start with the cash book balance, we should arrive at the bank statement balance. So in between, there will be pluses and minuses for the differences. The adjustment we have to make for the differences. Either there will be an addition or deletion. Okay, so if you look at this, so if you take this 10,000, what has happened? This 10,000 was deposited, right? Since this was deposited in the bank, in the cash book, our cash book balance is more, right? Has it been credited to the bank? No, the bank account is less, right? So this 10,000 we deposited, our cash book is more. However, bank statement, it was not credited. The bank amount is less by 10,000. Okay, so therefore, to arrive at the bank statement balance, you have to reduce this, how much? 10,000. Okay, this 10,000 has to be deducted. This is, we call it unrealized deposits. And the other one, 15,000, right? 15,000 we have paid to Silva. So when you pay, your cash balance will reduce, right? So your cash is less, right? By 15,000. Whereas it was not presented to the bank. So therefore, the bank balance is more, right? So therefore, to arrive at the bank statement balance, we should add back 15,000. What is that? Unpresented checks. Unpresented checks. Now, when you make these two adjustments, okay, you can see you are reconciling this. 105 plus 15, how much? 120 minus 10, 110. So you started with cash book and you arrived at bank statement balance by identifying these differences. There are two differences, right? So what were the two differences? We deposited 10,000, but it was not realized in the bank. Okay, and the other one, we issued a check for 15,000, it was not presented to the bank. Okay, so that's we have adjusted. Okay.